Welcome to the Broken Pie Chart Podcast, episode 333. I'm your host, Derek Moore. All right, with me, first time on the program, one of Zega Investments traders, Shane Skinner. Shane, what's going on today?
Not a whole lot. First time guest, a long time listener. It's a pleasure to be on.
No, first time, long time. You can't do that, can you? That's the sports call-in thing, right?
I just I, 333 episodes, man, and to be the first time coming on 333 times in, I feel it's an honor. It's a privilege. It really
All
is.
right. Well, let's get through the pleasantries and let's talk about the dollar. So, the U.S. dollar has been in focus, and I think we're hearing. I'll kind of set this up. I know you did some research on it. We'll talk through. Does the dollar even mean anything for equities? So, U.S. dollar index 97.588, I think is what it closed today. It was up a little bit, and the talk is that the dollar is done, and the dollar is weakening, and the dollar is this weakening dollar is going to cause problems. And here's a couple things I'll point out. Number one is the dollar today, and thanks to Daniel Lacal on Twitter, who had some charts, and then I pulled some of my own data, but I got the idea from him. The dollar's higher than it was in early, 2020, 2021. It's higher than it was basically most 2005, 2009, 2010, 2014ish, certainly 13. It's higher than it was in 90 to 94. So as Daniel points out, like this idea that the dollar is very, very low right now, it's not the case. On a relative basis, it's really not. And then Shane, I know you and I talked about, is there any relationship on an annual basis year over year between the S&P 500, let's say the year to year change, so what's the S&P up or down, versus the US dollar, the change in the dollar index. And I know you did some research on this, and I'll get to the punchline. It doesn't have any statistical correlation, right?
Yeah, the statistical correlation is essentially non-existent. And we first examined it on the broader index level. Let's just look at the S&P and the US dollar. Let's see there. And it was essentially flat, neutral. There's no correlation. I felt the need to take a stab at a running narrative that I've essentially heard since I was probably 18, 19 years old, starting finance school, is that, the change in the dollar, even if it doesn't affect the broader market, it's going to impact certain sectors or stocks in certain industries more than the other. And so, seeing this at the broader index level being essentially non-existent, my assumption was, okay, when I dive into the sectors, I'm going to see that there's strong negative and strong positive that just sort of evens out to neutral when you look at the broader index as a whole. And I couldn't have been further from the truth. The financials, tech, um, energy, right? I always been told energy is utilities because they're more, heavily leveraged in debt or financed in debt. That's going to be way more sensitive to changes in the dollar potentially, and it's just not the case. It's not there. So anybody that is basing what's the S&P doing today? What's the dollar doing today? Oh, if the dollar's up, the S&P should be down, or vice versa. It's not the case.
I mean, the other thing too is when we think about energy prices and we're going through this inflationary cycle, well, I would say there's really no inflation right now. It's been going down. Things like energy, oil, it's priced in US dollars. And so if you have a weaker US dollars, in theory, it lowers the cost of those hard assets, right? I mean that's kind of a benefit too of a lower dollar. But I know we're talking about the S&P. So basically what you're saying is there's no relationship. Like the dollar being down doesn't mean oil's down or oil's up. It just goes across the board. You didn't find any real valuable relationship there or correlation.
Exactly. We shouldn't be looking. We should still look at both of them. It's great. You should monitor the dollar. You should obviously monitor the index as well. But we shouldn't look at them. It's not a causation is not always correlation. When one's up and the other's down, it probably has nothing to do with each other. Um, and we do see that, we're talking about this on an annual basis, right? So, just to get into the more granular briefly, um, when investment decisions are being made based on policy decisions, right? Like they're becoming policy driven versus valuation driven. Okay, that's when we might see the correlation pick up or stuff get weird briefly. But what we're seeing is that if that happens, that's on a very short term. That's not on like a longer annualized long term investment horizon scale. Um, and so the reason why I say this is, God forbid we wake up tomorrow and, for 3 weeks straight, dollar up, stocks down, or vice versa, right? And you say, hey, there is the correlation. It's not in the long run. So, um, something to be aware of as well.
I forget how many years we went back, but for anyone who understands stats, the R squared. So I'm going to R squared. By the way, I'm not going to go into all the details about how it's calculated, but you're running these like an XY scatter plot, and the R squared on the change in the S&P 500 on an annual basis versus the US dollar since 1990. Why 1990? Easy for me to get that data back to then. The R squared is 0.0008. Essentially, an R squared of 1 would mean there's a very, very, very strong correlation between those two. What you find is there's really no correlation. In other words, just because the dollar's down doesn't mean the market's down. When you look, and I will say it was rare. I think there was maybe one, maybe two times since 1990 when both of those were down. Now, I've always said that the level of the dollar doesn't necessarily mean that much for equities until it does. With a lower dollar, though, in theory, companies who are multinationals and they are selling abroad, they are doing sales in local currencies. Those revenues, and i.e., also the earnings that come from that, are converted back into US dollars. And so when you have a very strong dollar, the same widget that you're getting from somebody's buying it in Europe, very strong dollar is when that gets converted back to US revenues, the revenues go down, the earnings go down. That's why we saw a lot of companies when they reported, they said, but for the strong US dollar, our EPS or our revenues would have been X% higher. A weaker dollar actually makes our goods more affordable. Sales, in theory, go up because you're getting more in sales after the conversion back. So it's not all bad, but I just go back. I was glad that the person I mentioned earlier, Daniel Lacal, had posted that and reminding people that the dollar is not it's not lower than it was back then, and we weren't seeing all these stories. The other thing he posted too, which I thought was interesting, this only goes back to July of 2023, but the US dollar share of international transactions top 50%. That's the highest level going back a couple of years. And so the share of transaction is higher. Looking at central banks, gold behind the dollar is the second largest component of global central bank reserves. US dollar makes 46% of that. Gold is 20%, euro 60%, other currencies 18%. And that was from the ECB, IMF, and Bloomberg. So, look, where it does matter, though, and I think we'll kind of transition to what we're seeing internationally as far as returns, is Shane, you look at how good some of the international markets have done year to date. The dollar being weak helps them because they're getting the bump and the tailwind from the relationship between their own currency and the dollar. And so this is one area, Shane, I think we're seeing that.
Absolutely. And so, this question, or more so this observation, and some might even argue hype, around the emerging markets and foreign markets out there that are seeing some fantastic performance in 2025. It's almost like, is that performance because there's so much growth going on over there? relative to the US, or is it more so based on the relationship that the US dollar at this time and whatever country we're, observing, um, the relationship between the two currencies, like you were mentioning, and I think that that's a huge part of it. Um, and so it doesn't mean that trade's over. Um, you know, I think we talked earlier, and you said that, you know, this trend could hold, it could continue, but at the end of the day, um, I don't think foreign markets, like the ones we're seeing perform well this year, is indicative of U.S. markets underperforming or not doing well necessarily, if that makes sense.
Well, look, I'm just going to say what I think, and it's you had a lot of people in April who decided that with the tariffs and everything, the U.S. market's not going to do well. We're going to go put money overseas, and between the dollar getting weaker, meaning the other currencies getting stronger, so that helps the performance of international markets. But you had all this money that switched to these indexes, and whether it's the ETF. Like I'll give you an example: the Poland ETF EPOL. I looked at the companies. I looked for 2 seconds. I'm not sure what those companies do. I'm sure they're great companies, but it's up 60% year to date through July 3rd. I'm looking at a chart that Charlie Bilella put out on Twitter. Greece is up plus 56.3%. The US at the time was up 7.3%. The total world, using Vanguard's VT ETF, which is the total stock market, up 11.4. Spain up 45.4. I'm not going to go through all these. Like South Korea up 43%, Austria 43%, Italy 36%. So, you look at all these. Argentina, by the way, is only up 2.9%. We'll have something to say about Argentina in a second. But what's going to happen is I feel like a lot of institutions, they move money there. Part of this is the flows, more buyers than sellers that drive these. And then what you're going to see is people are going to start to say, well, shouldn't I have some international? Because they're doing much better. And maybe they have a certain viewpoint on the world or political affiliation. They're going to say, I'm going to get out of US stocks. This is the place to be. I remind people, though, that most of the tech, so the growthier parts of the market, are in US stock market. And the Mag 7, they reached their highest high, I think it was December. The US hit high in February, most recently hit another all time high. But you know what's going to happen? Like people are going to say, oh, Poland's up 60%. I'm going to go put my money in Poland. And is Poland going to go up another 60% next year? I don't know. I mean, if you want to buy Poland, buy Poland. EPOL. I'll just give you the ticker. You can research it. But to me, like this relative performance, it would be surprising if it stayed, because over the last couple decades, the relative performance of the growthier parts of the market compared to the more value-ish, the financials, the industrials that you see overseas, it's just really different. So, I mean, Shane, don't you think? I mean, there are retail traders out there being like, "Oh, I have to get in on these." Like I saw in 1998, everyone got into emerging markets. The Merrill Lynch Dragon Fund was up, I don't know, 80%, and people started buying the Dragon Fund after it was already up 80%. I don't even know if that exists anymore. But people are going to chase this, right?
Of course, I mean with anything that's generating a return. In my time on the retail desk at TD Ameritrade Charles Schwab, I saw people chase cocoa through certain ETFs and ETNs. I saw people chase, fixed income stuff that normally never trade. At the end of the day, if stuff's moving, right, and it naturally pulls money in. Um, where I worry about this, from the standpoint of have someone missed the boat? Are they going to go up another 60%? Obviously, we don't know. They could. But think about two things. One, if all of a sudden confidence, that apparently lack of confidence to maybe an extent, is what drove some of this money outwards, and into Europe and out of US equities. Um, what happens when everybody realizes or comes to the conclusion that they think there's more growth to be had here in the US and it's time to take gains from Europe and move them back in here? Um, if you're late to the boat getting out of Europe and back into the US, um, when these flows eventually return, willing that they return, right? Um, you're gonna miss out, right? And so that's another thing that I don't know if anybody's really considered. Um, these people getting into Europe, are you gonna sit in that for a couple of years? And if so, you know, best of luck to you. Um, but at the end of the day, if all of a sudden US markets explode, we see growth here and money starts coming back in fast, the last thing you want to be doing is trying to get out of Europe as everybody else is and rotate back into US. So it'll be interesting to say the least how we see that play out over the next 6 to
It's
18 months here.
It's funny you mentioned the cocoa market. That was one of the unbelievable uptrending markets past 2 years or so. I don't know if it's still doing that.
Died down a
I
little bit, but yeah,
It did. Didn't they shut down the cocoa ETN, exchange
they
traded
did.
note?
They stopped, yeah. And I mean, I knew people who made a killing on it, and uh,
Well, I think they shut it. Didn't they shut it down before the really big run? I feel
the
like
big, I I gotta go check. I forget the name of it. I'm gonna have to reach out to my buddy after this.
wasn't there NIB like nib
Nib.
NIB like a cocoa like a I thought
There
that
was
was
an
one.
ETN. I know there was an ETN specifically. It
Yeah,
wasn't an ETF, but
there was something in London. I thought it was on London or Europe. They had a cocoa ETN. Well, it was just didn't they have a coal ETF and they shut it down before coal prices went up? I don't remember some of these, but
it's happened. I think it might be Nib and Chalk. I think like not chocolate, but CHOC. I think that was one. If it's not still going, it definitely existed. Yeah, I don't.
that was a London
That was the
one.
London one. Yep. I remember though that just people from all over the place who never traded cocoa, right? All of a sudden, everybody's got to have it, and so it's funny to see these trends pop up, right? And some of them are, you know, hold, right? Some of them are short lived, and that's kind of what I was just getting at, right? Is similar to the cocoa trade. Like if you're riding that thing up and you got in early and you're able to get out clean, it's a fantastic trade. If you're buying, again, 60% up on Poland on the year, and God forbid half that comes back next year, yeah, that's a tough ride down, and you're probably kicking yourself. So, at this point,
You're
if
not
it's
early if
really,
you're buying it now. Look, I don't
yeah,
know what's going to happen. Neither of us do,
you're
but you're not
fair,
early
fair
if
enough.
you're. A famous technician used to say that when he looked at a chart. He's like, "Look, you're
Hey,
not early.
buy high,
Maybe,
sell higher, right?
yeah. I mean, part of it is the technical analysis would be buy high, buy in a breakout, sell higher. But I don't know. All right, bringing this back to the dollar. Yeah, I mean, these are all helped by the dollar for sure. The dollar has been down off its highs. If you look at, let's see, emerging markets, yeah, like emerging markets is up 17.5%. Vietnam up 21.5. I mean, so Argentina is interesting. They had their run, not this year. They had their run. What was it? Probably the year before. And I think I saw a stat of if people would have bought it. So when Javier Milei was elected president of Argentina, their markets had sold off. And Daniel Lacal had retweeted something, same person who gave us the oil charts, that I think there were like 100 economists who said that if this person gets elected, that market will basically crash and not do well. And then Argentina went on a run. But that's a good example. Like Argentina, there's only one ETF, ARGT. Don't buy it because I'm talking about it. If you want to buy it, buy it. If you don't, if you want to short it, short it. Do whatever
This
you want.
isn't an endorsement to do anything. We're
Yeah,
just talking about
but
our.
there's only one ETF for Argentina. So I don't know how many there are from Poland, by the way, but there's one, and it's up 2.9. So that's a good example of where imagine if everyone just dove into Argentina after it was up really, really big. I'd have to go look and see what the annualized returns were there. But anyway, I mean, to me, if it's, I think there'll be, when you look at AI and you look at some of the tech companies and the productivity gains, there is another theory too that it's when you have stocks that are industrials, more old line firms, when you have a major technological advance, what happens is the old line companies eventually gain productivity gains. So they become more productive. And I think AI is one of those things that could actually, everyone's kind of looking at the net profit margins, 13.5% is projected right now. And everyone says, well, that's got to go back to the long term average. But if AI comes through, we could see a situation where productivity gains are made and it seeps down into the value space as well. But that's a whole different discussion.
Absolutely.
So,
That's an entirely new podcast, but you're right. You're absolutely right, and it's just a matter of who, what, where, and when, right? When does that happen and where? And I don't think at this point it's a matter of if, it's more so when. Um, but we'll see.
I mean, anytime we were talking earlier about when I first started in markets, and we had to write on a paper ticket the order, and this one firm I worked at, and we would write it on the ticket. It was 3 copies. We would take off one of the copies and put it over like a spiky thing that somebody would do whatever they do with those copies, and then the other 2 carbon copies would get put into a tube. I throw it into the wall. It would get sucked down 10 floors, and they would call the trade into the exchange. The exchange, somebody at the exchange would take the phone call, write a ticket, give it to a runner. The runner would run it out to the trader. The trader would do the trade, and then eventually the trader would let somebody know, "Hey, you have a confirm here." They would call that whole reverse process, and so like that's just a good example of where there's so things are so much more productive now when technology comes in. So if AI comes through as the next great tech revolution, much like I think the internet obviously was, and the chip that Intel started in the 1980s, probably late 70s, it it could really do some things. All right, so what else do we want to talk about? Taxes.
Yeah,
Yeah, let's talk
please.
about this a little
Yeah.
bit, Shane. So I don't know if you're familiar with this. Apparently, there was a big bill that was passed. I've heard some things about that.
Some call it ugly, some call it beautiful. I call it a bill. It's a
It's a
bill.
bill. So I this gets into the debt and deficit, but I think sometimes people focus on the tax rate. And we went back and you can do this through Fred, which is the Federal Reserve Bank of St. Louis. And I went and I pulled it's a graph of the top marginal tax rate. Right now, I think it's what, 37%, I think. Yeah, 37%.
Yep.
And then it goes, and this is kind of from like 1930. So we look at it and it says, what is so you bring in revenues. When you bring in revenue as the federal government, you bring in what they call receipts, federal receipts as a percent of gross domestic product. And over time, when you look at this, basically the average is about 15 and a quarter percent going back, to the 1930s. And then you say, well, what do they spend? What does the US government spend? And they always spend, it seems like, more than they take in. The internet bubble, late 90s, there was a surplus. But think about it, everyone who was selling and getting capital gains, that was a big
Right.
deal.
Right. Well, and
But
also
the average,
surplus means more money's coming out than is going into the market economy. So doesn't
yeah,
surpluses don't necessarily mean good things. That's probably a conversation for later as well.
yeah.
Um,
But I'll just tell you, I mean, the average that we spend is about 18 and a half of GDP. So if we take in 15 and a quarter and we spend 18 and a half, this is irregardless of the tax rate. So this is the same when the highest tax rate was 90%, when it was 70%, when it was 50%. It sort of doesn't matter. And so if you're looking at this, you would say if you want to grow the revenue that's taken in, you have to grow the economy. And
Absolutely. Yeah. Clear as day. And to cutting spending is actually how you are going to reduce the budget, not raising taxes. People think that if we just raise taxes, we'll be able to do whatever we want, and it's not, or I shouldn't say whatever we want. We'll be able to pay off more than prior, and it really just doesn't happen. If anything, in some of these years here, the tax rate goes up, and then the difference widens. So yeah, it's just doesn't seem to be any correlation at all here.
What I would say too, normally the cigarette tax. So they enacted, I think it was in the 80s. I could be wrong. New York City is a good example. They put taxes on cigarettes. And part of the reason why they wanted to tax cigarettes, one, because they wanted to generate revenue, but two, they wanted to try and change a behavior. And generally, when you raise tax rates, it does impact growth. So if you look at this and you're saying, if they hired us to be consultants to the federal government, we would say, well, you probably should focus on things that you can do to grow the economy and grow GDP. And it's just interesting when you look at the data. It doesn't say that you generate more as a percentage of GDP when tax rates are higher. So grow GDP. That's kind of what matters.
Less about what we're printing and more about what are we doing with the actual money? What's it going to? And are we more conscious about how we're spending that money as a government or as a country, or are we being more um, laxed, if you will, if that makes sense?
So you're younger than me. Let me ask you: Do you think the debt matters? Like, is the debt? Do we have a?
Brutally honest, no, no, I don't. This isn't a full subscription to like monetary or modern monetary theory. I still don't know how I completely feel about that, but at the same time, you know, understanding the relationship with the Federal Reserve and the government and how it all works, I don't think the debt was ever supposed to fully be paid off. It's more so, again, if we're printing off a bunch of money and then going and using that money to allocate certain resources, that should, in theory, control the inflation of that resource, right? If we have a ton of oil supply, right, the price of oil shouldn't be that high, in theory. But if we print off a bunch of money, we don't up oil supply. If anything, we reduce our oil supply, and all the money we printed off gets spent doing God knows what, with nothing to do with allocating, resources. Okay, well now all of a sudden we widen the deficit, and at the same time, none of that money was used to allocate the things that we're going to be buying. So I think it's something that's been long overdue, and the government really needs to start focusing on what are we actually spending our money on in terms of supply and demand and what people need in this country.
The good thing about being older is you get pleasantly, I'll call it skeptical or jaded. Politicians want to get elected, and this is nothing is ever going to change. I've already resigned myself to the fact. I thought debt was a problem
Thanks.
in the
You're giving me
1980s.
so much hope.
1970s, 1980s. Like we talked about the debt in the 1980s. It will matter when it matters, just like the dollar. It matters when it matters. And so far, despite the debt, the U.S. economy, I mean, the U.S. businesses, the economy has done pretty well. Now, there's studies that start to look at when net interest payments or interest payments on the debt start to absorb too much of the GDP, then it could cause some problems. But I take this back to investing. I mean, this is why we sort of buy and hedge. If you're somebody who is saying, I don't like this debt and deficit, I'm going to go to cash. You probably were in cash since the 1980s. And I know it's higher as a percent of GDP now, but I hope people aren't making investment decisions based upon that. It's like to buy the market, we like to hedge. The other thing I'll say is, every country, this is a relative game when you're looking at the US versus Europe versus France versus Germany. And there are differences in each of those respective debt to GDPs. Japan is the famous one where they're like 250% of debt to GDP, and people tell me they're buying their own debt or different governments own pieces of different debt. But this is a relative thing. It's not like the US is 100 and something percent of debt to GDP, but France is 10. It doesn't work that
Right.
way. They're
It's
all
yeah.
spending.
Which this is the age-old phenomena that we witness in statistics. We can dress anything and make it look any way we want, good, bad, ugly. Um, at the end of the day, like you said, relatively speaking, we're not that out of line with the rest of the world. Um, so no need for the chicken little sky is falling act just yet, I don't think.
Well, it's going to matter at some point. I just can't tell you when
Eventually,
that
yeah,
is.
right, right. And at the end of the day, good luck predicting that, right? It's probably not possible. So,
You may not
um,
remember this, but Greece, well, you probably remember this. What year CNBC was live in Greece, and this was when the IMF and the Eurozone had to bail out Greece.
yeah,
Their
I
debt
was
to
younger.
GDP is higher than
Right,
it was back then, but
right.
it's not a today. It's a problem when it's a problem. It's a problem back then. It's not today.
Exactly. If you don't mind, I want to put you on the hot seat with a quick
Okay.
question. Um, sort of backing up a little bit to that comment about the interest on the federal debt, right? And the fact that, you know, the more we start paying in interest, the more that's going to eat away at that GDP. In your opinion, do you think that's more of a responsibility for the Federal Reserve to accommodate interest rates so that the federal government can operate a little bit better at maybe produce better GDP number? Or do you think that that falls on the government to be more conscious about its debt and how it's spending its money? Or do you think it's a little bit of both?
I mean, in a perfect world, I honestly think interest rates should be about supply and demand and get to some sort of equilibrium. That's how it was back before the Fed was created. So, I would rather them not be involved in deciding what interest rate policy is. And quite frankly, I'm a contrarian on this, but when we had inflation, I don't think them raising rates did anything to stop inflation. It was supply side problem. We sent a bunch of money out to people. They bought stuff on Amazon. The ships had to come in from China. There weren't enough capacity. Shipping costs went higher. So I don't think, and honestly, they could lower it to 3%. They could keep them at where they are now. It's not doing anything for
It's not
inflation.
actually.
Housing is a little separate, for sure. As far as the debt, though, I mean, it was probably a mistake not to use longer term debt when they could have. I mean, the 10-year was under 1%,
Exactly.
and they were doing near
Exactly.
term paper. I don't know why
Right.
they were doing that.
Right. Well, and then, you mentioned the essentially allowing for demand to stay high by sending more money out so people can buy more stuff, right? And really that whole scenario to me, I always viewed that as like if anybody who's listening has been a part of something where a bottleneck occurs, um, it's like the assembly line speeding up after the bottleneck has occurred, and it's like, whoa, 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 we should slow down for a second. Let's give the belt a, a second to catch up, get back to normal, and instead we kind of just we ripped it through, and it here we are. But um, I just don't think that in retrospect, right, hindsight's always 2020, but we could have probably managed that better. And I agree with you as well on the interest rates. I don't think they'd made a dent in inflation.
What it does tell you is that apparently, and this is the government sending people checks directly, the people seem to spend it more efficiently than the government does. And so,
Makes you wonder. Makes you wonder about the future of a potential universal, or not a universal, but you know, currency
Universal
or
basic income.
universal basic income. Yes, thank you.
Yeah, I mean that's so for anyone who doesn't know what that is, the idea is that governments, and it doesn't matter if it's the US or Europe or somewhere else, one of the countries in Europe or anywhere, they would, instead of having programs like unemployment or social security or any number of these programs like food assistance or housing assistance, you would get rid of all welfare programs. You would get rid of all that. And instead, you would substitute it and just send people money, and you would let people do with it what they deem they should do with it, and let the individuals take. So,
Some
yeah, I
people
mean,
would seize that and do really well with it, I think, and I think other people would continue to make poor decisions, and that's why it's such a hard argument is whether or not it would work, because at the end of the day, how do we know what, the majority of individuals are going to choose to do, right?
yeah. All right, let me wrap this up with just giving you a couple stats here. Net interest on the debt. This is according to JP Morgan's Guide to the Markets as of, let's see, this is 2025 federal budget. Net interest payments are basically going to be just under $1 trillion. Social Security, 1.57 trillion. Medicare, 1.14 trillion. Medicaid, 656 billion. Defense, 859 billion. Other mandatory spending, whatever that is, 855. And then non-defense discretionary. So that's yeah. So I mean, your net interest payments are pretty much, they're higher than defense, they'll be higher than non-discretionary, and they just, Social Security is the big one, and then so yeah, I mean it that is crowding out some of the other things, but um, anyway, we'll see what
Yeah, we'll see.
happens.
Diamond came out today, I believe. It said 40-50% chance they raise. So we'll we'll see. I was
Who
shocked to
said
hear
that?
that.
Jamie Dimon said
Yeah,
the Fed's going to raise.
yeah.
Come on, he's been wrong on that for a while.
According Walter from Bloomberg is where I got that. So, but off Twitter. But yeah, I believe that was said. So, um, it would be interesting to see what becomes of that, knowing the current administration's stance on the Fed and what they would prefer to see with interest rates versus going in the complete opposite direction of what they've been voicing. It'd be very interesting to see what happens. But you're right, Diamond has not always picked them right. So we'll
Well, he also said an economic calamity is coming, and the market just made another new
another
all time
high
high. So
naturally.
go figure. Okay, inflation. We're going to get the CPI and PPI next week. So after this comes out, I mean, some data came out. Let me see who put this out. This was, who the heck did this? Created with Data Wrapper. Okay, that's what they used. I don't know who came out with this. Sorry. Asking rents for the fall for two-bedroom apartments, year-over-year change in median U.S. asking rent by bedroom type, and basically it's 0% for three bedrooms plus, minus 0.2%, and minus 1.5% for two bedrooms. So they're down. I mean, we continue to see there's no inflation right now, despite a lot of the parabolic talk about surging inflation due to the tariffs, and we just haven't seen it.
Yeah,
And until proven otherwise, there's no inflation right now. When I said there's no inflation, remember, prices generally don't ever drop. They just stop going up as much. The rate of change.
exactly.
So
Exactly. And
we're not
being
seeing
young,
anything.
yeah, being younger, renting, I lived through this phenomena over the past 5 years as a renter where it was actually cheaper to rent the following year, my first year out of college, than it was the prior. And then it got more expensive the following and the following. And now I'd say for the past 2, 3 years, like the chart says, you really haven't seen um, the change in rent. House prices, are different, but in terms of rent, um, it's not going up anymore. So if we can see that across the board, and the majority of um, you know, products, goods, services, things of that nature. This flattening off, like you said, is happening and you believe will continue to happen. We should be just fine.
You know what's not dropping off? Leisure travel. Like airports are packed. Hotels are still charging 3 times, 4 times what they were
Yep.
pre-COVID. It's insane what they're charging.
Cruises are packed. I was just out at the Denver airport and it was hours long wait to get through stuff. So um, that's one thing that I noticed past couple of months when I've traveled is I don't think I've seen or been on an empty plane yet. So we'll see how it plays out.
Yep. Does JP Morgan come out with earnings next Friday? I feel like the banks start
They
next
kick it
Friday.
off. I think so. Let me double check.
So they are. I'm just looking at the implied volatility, and what's the near strike? Yeah. So for
JP Morgan
example,
next Tuesday, I think actually.
next Tuesday. Okay.
Yep.
So let's talk a little bit about implied volatility and earnings. So JP Morgan right about 288 at the close today. If I look at the 287.50 options contract for this Friday, the implied volatility is 16.69. I go out to next week, so July 18th. That is not Tuesday, but it incorporates the week. And I look at, I don't know, the 280s, somewhere around there, 31.5% implied volatility. So,
I'm gonna take a guess. Are we about plus or minus 12, $13 a share, up or down on next week's expiration?
well, I mean, 31 vol divided by 15.875. The 1 day is 1.95, and we got what? What is that? Friday, Monday, Tuesday. So we got 3 days.
3.
Yeah, so call it a roughly a 2%. And we got the square root of 3 times 2% times 2. No, it's about 3.5%.
Nice.
Not too much.
Not too much at all. I feel like, and this is how the market goes, right? It's seasonal, there's cycles and stuff, but for a long time we were really seeing a lot of stuff getting priced into earnings, 10% ranges, right? And so for this to be a little bit more tamer, 3 to 5%, it sounds, or less than 5%, you said 3.5. I don't know. To me, I like to see that. It seems like people are calmer going into these earnings than um, past couple of.
I mean, it is a bank. It's not Nvidia.
It
Let's
is.
be honest.
Yeah, they're not trading. They're not the largest company in the world. So that's a good point.
So basically, if you bought the straddle, the stock would have to move up or down 3.5%
Which is
to
about
break
12,
even.
$13, which is currently basically our all-time high, or back down to about where it broke out of its previous range before
Yeah.
dipping to its most recent high. Which, again, it all flows together. Whether you're charting or looking at the options, you know, it's all relevant.
So just thinking about earnings, when we look S&P 500, this is a headline EPS. So there's different ways of looking at EPS, but this is a Bloomberg chart. Headline EPS is roughly, $280, the forward 12-month EPS. What happened, and so earnings estimates going forward 12 months are higher than they were back before the tariff tantrum. And we saw so patented that analysts did this. The markets go down and they lower their estimates, like they follow the market. And then the
Right.
market goes up and they were late, but the market bottomed before earnings bottomed. And then the market goes up and then they start chasing it. And we see this with the year end targets too. The investment banks, they lowered the targets and now they're back up again.
And then they're chasing. Yep. It's too reactionary. It seems like they're always one step behind in the process.
Yeah. You'll see. I mean, in December we do the prediction show, and basically when you do a prediction on the market, if you're trying to predict where the market will be 1 year later, December 31st, 2026, and you're doing the show in December of 2025, you're basically saying in 1 year, what is the forward 2026 12-month earnings estimate per share going to be on the S&P. And if you knew that number, you still got to figure out the multiple. And if you get those two right, then you
And
can predict the markets. But
right, right. No,
a
it's
10%
almost
change in the
reverse
multiple,
engineering.
yeah. But I mean, if your earnings are stagnant year over year and you have a 10% increase in the multiple, the market's going to go up 10%. Or you have a 10% increase in earnings and the multiple stays the same, you're going to be up 10%. If you do
Right.
them twice, you're up 20%.
Well,
So,
again, and this is where, look, that productivity thing, I know we'll probably bring it up later in another talk, but with AI and, you know, it's just a
well,
matter
it
of
goes to
when.
margins. It goes
Right,
to net profit
exactly,
margins. Yeah.
exactly. And when that happens, like you said, you could have people or companies, right, that have been lagging or, just not performing as well as others out there that benefit so greatly from the productivity boost that the bottom line improves significantly. And, what was a dog for the past couple of years or decade might all of a sudden be something you throw in your portfolio.
All right. So we're coming up on time. This is the point where we do some recommendations. And I took this from Barry Ritholtz. He had a podcast and a radio show. What is Bloomberg on the markets? I think it was. I'm forgetting what it was. But anyway, Barry used to ask his guest, and he used to talk about what do you say? Were you reading, watching, listening to, and a lot of times it was just movie recommendations. So I do have a movie recommendation, but anything you have for the audience, Shane?
Sorry, muted. My
You,
fiance and I just finished The Sopranos, and I'm sure everybody else out there listening has already been through it, but
you're not early. You're not early to this one, but
it's
yeah, go ahead. We have
fantastic.
younger listeners,
Um,
sure.
no, no, definitely recommend that. Uh, Mike, who just joined our team, recommended I start the Formula One series on Netflix, so I think that's what's up next on my list there. And currently reading, I actually just finished Going Infinite. Um, Read through basically talking about Sam Bankman-Fried and the whole debacle that was the crypto fallout from a couple years back. So very interesting read.
You should, if you like that book, I think the better book is Number Go Up by Zeke Fox.
Number
Uh,
go up. Okay.
Zeke, Faux, but I think it's pronounced Fox. I believe he's a writer at Bloomberg. But he had interviews with Sam Bankman Fried before all that stuff went down. And he's a little bit more of
Interesting.
a skeptic of crypto, which I like. So
Yeah, it seemed like, it wasn't that he was necessarily painted in a positive light in Going Infinite, but there was some sense of empathy and almost feeling like, oh, this is just some kid who bit off more than he could chew.
I think Michael
I,
Lewis comes out looking poor. I'll just say it
yeah,
on
no, I
this
mean
one.
Lewis, yeah, no, and this will be interesting. I'm gonna have to read this just because I'm with you. Like, I don't think any mercy should be shown. I think he knew what he was doing, and if
They
you're
commingled customer funds.
yeah, yeah, and
Like
if you're
Schwab can't
that
do that.
deep, no,
Yeah.
never, never. It would be a fallout if so, and so if you're that deep and you know it's wrong, you should speak up, right, or stop it. And it seems like he just doubled down every time, and it's just proof that it's almost like the risk of ruin, right? The more you stack your risk, the higher and higher you stack it, the more greater the odds are that it's going to just come falling back down.
I am giving a strong recommendation for. I finally saw the new Mission Impossible: The Final Reckoning,
Really?
and yeah, I mean I've seen them all. And if you're a fan of Mission Impossible, Tom Cruise gives you exactly what you want. He gives you the action. He gives you the cloak and dagger. I thought it was really good. It might be the best one. The first one was the first one, but I think this might be the best one. It's supposed to be the last. So my son had seen it with his friends, and he wanted to see it again, and I wanted to see it, so we went the other day. Pretty good. I give a strong. It's on my conviction list, strong buy list.
Good to
Mission
hear.
Impossible.
It's good to hear. Hollywood's been iffy lately the past couple years for some people, so I'll have to check that one out. I've needed a good action movie. I feel
See
like
it in the theater though, if you can.
yeah,
I
oh
think it's definitely
absolutely.
a yeah.
That's something that needs to be discussed later. Is people need to start going back to movies. We've got a drive-in out by us
Well, I
that's
saw the
awesome.
F1 and I saw this one within the
Yeah, yeah,
last
yeah,
3
yeah.
weeks. So
I've heard phenomenal things, not just from you about the F1, but just from everybody who's seen it. So
you should go see that. That's on my conviction list as well. Those are two strong buy recommendations there for sure. We were coming out of the Mission Impossible movie, and right across the way was the F1 movie. And I looked at the time it started. I'm like, it's probably right towards the end. So I'm not going to spoil it for anyone. But I said to my son, come on. And he's like, really? I'm like, yeah, come on. It's fine. We'll just go in the other theater for a little bit. So we watched the last 15 minutes, which once you see the movie, you'll know what part I'm talking about. But yeah, because we had seen it prior, but we watched that again. So
so in other words, the last 15 minutes of the F1 movie are worth sneaking back into the theater to watch over
I'm
a
just
second time.
no, I'm just no. The whole thing. It just that's how the timing. Our intention was not to go see two movies in a row. It was just, oh, you know what? I'll bet you it's towards the end. No, see the whole thing. It's really good. And if you like music, they have really good music in it. So
Perfect.
there was a Zeppelin song that started the movie, and I don't think
Can't go wrong with Zeppelin. I mean,
yeah,
right
I
out
don't
the
think
gate.
I don't believe they just give rights to anybody
No,
to.
they don't sign off on anything hardly ever. When I was a kid, one of my favorite movies growing up was The School of Rock with Jack Black, and for them to get Immigrant Song into that movie, Jack Black filled a theater full of people and got them to scream and beg and plead Zeppelin to let them use the song, and they signed off on it.
Interesting. Almost Famous was another one that Zeppelin had songs in, and that director I think went to them, and he also got Joni Mitchell. He got Neil Young. I think he got a bunch of people. So anyway, all right, that's it. I'm calling it. Shane, thanks for coming on. Good to have you on. Sure we'll be back. And for everyone else, we'll see you next week. Take care.